Every time gold makes a new high, Indian feels it twice. Once in our investments and once when we step into the jewelry shop. And right now, gold isn't creeping higher, it's exploding. Up over 10% in rupee terms in less than a month. Central banks are hoarding it, investors are rushing in, and even crypto companies are talking about gold. So the question is this just another spike or the start of something much bigger? When gold moves like this, it's not just about shiny metal, it's a signal of stress in currencies, in global trade and in financial systems. Globally, gold has smashed through record highs, and the world's largest gold ETF, SPDR Gold Trust, is holding record levels of bullion. And central banks, including India's RBI, are selling US treasuries to buy gold instead. That's not noise, that's a structural change, a thrust that US dollar is weakening. See, the math is simple. When interest rates fall, gold becomes cheaper to hold. When the dollar weakens, gold strengthens. And when central banks keep buying physical metal, supply tightens. Add one scary fact: the amount of paper gold traded 100 of times larger than the actual metal involved, which means even if one big player demands delivery, prices could gap violently higher. That's why some analysts are floating extreme targets like $5,000 or even $7,000 an ounce. And it's not just India. Poland's central bank wants to raise gold reserves from 20 to 30%. Stablecoin giant is talking about investing in gold miners. Ironic, given crypto was meant to replace gold, that's the level of nervousness in the global system. For Indians, the impact is direct. Jewelry is already 10 to 12% more expensive than just 3 weeks ago. Higher imports risk pressuring the rupee, but investments look interesting. Sovereign gold bonds offer exposure plus 2.5% annual interest and tax-free gains. ETFs give liquidity for tactical trades, though they are taxable, and physical gold has costs with no yield. So what's the tactical playbook? Keep a core allocation in SGBs for safety and tax efficiency. Use ETFs for tactical moves around Fed policy or geopolitical shocks. And if you want to add some spice, maybe a tiny slice into miners. But remember, that's a risky leverage. The key here is don't chase every spike. Gold is a hedge, not a lottery ticket. And here's the extra context most people miss. Every major financial crisis has seen gold outperform. In 2008, when banks collapsed, gold nearly doubled in next 3 years. During the pandemic in 2020, when gold debt surged, interest rates went to zero. Gold broke past $2,000 for the first time. Now with US debt crossing $35 trillion and China aggressively stockpiling gold, the setup looks eerily similar. This isn't just about price action, it's about the world quietly preparing for a reset in how we store value. Well, I don't think this is random. It reflects global distrust in the dollar and in financial stability itself. And for Indians, it's both blessing and a curse. Wealth protection on one side, higher cost on the other. Use it smartly, size it right, let it anchor your portfolio when everything else looks shaky. If you found this breakdown useful, and do not forget to subscribe to discover.ai. Don't forget to check out our Instagram as well. We post quick market updates there every day, and explore discover.ai. It's designed to make investing simple, transparent and stress-free. Links are in the descriptions below. Stay tuned for the next video. We'll break down whether now is the right time to buy sovereign gold bonds or if it's smarter to wait for a correction.